Okay, this is Professor Hazera to finish the fourth of the ratios on doing in this case, doing a quick valuation of a firm. And we had the first three ratios covered the inputs, the calculation of free cash flow at 38,741, and finally the calculation of the value of the super growth period at 315,254. Now, the final part of this is we're going to end up with some estimate, some rough estimate of the share price, and this is going to be pretty rough. But anyway, so we're saying that for the first 5 years, the firm is worth $315 billion. Now, if you go out past the fifth year, there are equations, and I'll let your finance people take care of that, that can actually put the value on cash flows that start at some year and go on forever. That makes it incredible, but the calculus that you use is actually pretty algebra and calculus is actually pretty easy. So, and the formula we're going to use is it's sort of sometimes called the Gordon growth model, or it's a derivation of that model. But this is the formula we're going to use, and that formula is going to have a numerator and denominator. The formula is if you want the present value of a cash flow today that goes in the future at a constant growth rate. And by constant growth, we mean a very slow growth rate. Here's the formula you're going to use. We're going to take the cash flow at the current year, at year t plus 1, which means the current year plus 1 year up. And we're going to divide it by, I hope you see this, by the constant growth cost of capital. That's CGCOC. That's down here, minus the constant growth rate. So the numerator is going to be the cash flow at year 6. P is equal to 5 in this in these symbols up here. And so we're going to take the cash flow in year 6. We're going to calculate that. That's going to be our numerator. And our denominator is simply going to be the constant growth cost of capital less the growth rate. And we're going to divide by the two and work from there. Okay, so how do we get the cash flow at year 6? Well, we're assuming that at year 5, your cash flow is 83 billion. But we're assuming that as of the end of the fifth year, the company only grows at 1%. So what we're going to do is, that's pretty slow growth after that. So if we take year 5 cash flow and multiply it times 1 plus the growth rate starting in year 6, which is only 1%, that gives us large cash flow but pretty small cash flow. That's our numerator. And our denominator is going to be our constant growth cost of capital, which is right here. It is constant growth period, cost of capital, 3%, minus our numerator, our constant growth rate of 1%, right there. So our denominator is going to be equal to 2% there. Let's put that over here. Okay, so if we take, actually, this is a fraction. If you take 84,692 divided by 2%, which is the difference between the constant growth cost of capital, constant growth C of C less the constant growth rate, then you end up with $4 trillion, something like that. And then this all depends on how many zeros you put on there. It looks like that. Okay, and then here's the problem. This is going to give us, because we took the fifth year cash flow and then put it into the 6th year. This really gives us the cash flow at year 6. This gives us the value of the company of the terminal period at the end of year 5, because we based on the 5th year cash flow and grew it at 1%. So what we've got to do is sort of like breaking through a barrier. We've got to take this cash flow, which is the value of the company that from the end of year 5, from the end of year 5 to forever. We've got to take that and discount it back to the current. So we've got to multiply that times the 5-year discount factor, which just so happens to be right here. So if we do that, we come to this. Now this will give us the present value of the terminal period. So first of all, we had to compute the present value of the cash flows in perpetuity from year 5 forever, going to forever. And then we had to take that value and discount it to the present, which tells us that it's about 68%. Okay, so the total value of the firm is the value of the 5-year period times plus the value of the terminal period. So that's the present value of the firm. And we'll just move it down here, present value of the firm. And then we'll just get the number of shares. And the number of shares, we can get the number of shares from the income statement. The number of shares from the income statement are, let's go out here, the basic earnings per share of the income statement, number of shares of the income statement are 7,600. And that's going to give us a share value of $420 per share, which might seem high, but we haven't taken out debt. Keep in mind, so this is really the value of the assets per share, and keep in mind it's also very rough. One thing that you'll notice, and this is a problem that you have in all these models, is that these models are very sensitive to the denominator. So let's say that we said that our constant growth cost of capital was 4%. Just that amount right there would give us 3% on the bottom and would lower our value to 293, which would be more in line with what it's currently trading for. So just keep in mind that, and this has just been a problem in years for finance, is that the sensitivity of the terminal value to that the denominator right there. So people sometimes go, it's going to be 2%, 3%, whatever. It shows you the subjectivity of these models. What these models do to me, this is the richest part of the model, which is really telling me this cash flow from operating income, taken out 42, take out the cash flow, the operating income less the conversion to cash net income, about 42 billion, 41 billion. That's more than enough to cover your capital expenditures. So because this number dominates this capital expenditure number here, this company has a lot of cash with which to pay dividends and do anything it wants, basically. That they've taken on any debt might be surprising. Maybe, I mean, it's different corporate financial policies. So the current price is 202.49. If we increase the cost of capital for the cost of growth period 4%, we get about 290. Either way, I think the stock is a buy, but we'll be taking a look at it. Anyway, so I'll put these videos up, and this will help you for the class. Thank you very much.